Good morning, ladies and gentlemen. I'd like to start today with what is going on in the bond market, and that is that term premia are expanding. Now, what is a term premium? And that's the extra return that an investor will earn by holding longer term bonds instead of rolling over a shorter term bond over the life of the longer term bond. So, what does that mean? That means A, that the yield curve is steepening, but also that the term premium is driving up real rates. That is excellent for investors longer term, but brings pain shorter term. If we look at where term premium now are, historically speaking, we are now around 70 basis points, which is around the high that we have seen for the past years. If we zoom out, and let's zoom out all the way out to the 1990s, we are not in a particularly high level of term premium, but we could easily get to around 100 basis points. We are breaking out of this area here that we've been for the past 2 or 3 years, and we are going up towards the 100 level. Now, why would term premium expand now? I think there are a couple of reasons. One is the change in the administration and the possibility, I wouldn't even call it a probability, I call it a possibility at this stage, that the funding is going to be changed, i.e. that Besant, with advice from others, is going to decide that the US needs to fund more at the longer end of the curve and less in bills. And the sheer fact that we have many trillions to refinance, whether you think it's 20 or 25 or whatever, but trillions to refinance from short to long over the next couple of years. Don't forget that Yellen has been funding everything short, or mostly short, and now there's this possibility that that will change. That is driving up term premium, and I would have thought that this chart tells you that we are busting out of this, 2-year, 3-year period, and it could easily get to this kind of area, 100 to 110 basis points. That in itself is driving up real yields. And these are real yields, and you'll remember this is to the 255 area the October before last, when I said all in. We're going back there again, and if we zoom this out, we see that we are going to be approaching the 275, 280. I would completely disregard this because this was a technical happening during the crisis of 2008 and 2009. Real yields have not been any higher than 280 at any time, and we are approaching those levels. We are now around I would call it 235. This is from December 26th. It's not updated. 232, 233. So we probably have another 30 basis points to go there before we can call it safe. And that is going to have a very nasty effect on all asset prices in the short term. Remember that this is good longer term, because the higher the real rate, that means the higher the real return your assets will earn over time. But in the short term, while it adjusts to those levels, there is some pain. To decide if it's term premium or real rates, I look at basically the 5-year forward inflation expectation rate. If this rate is stable, and basically it's been within 20 basis points for a long time, 220, 240, what is the market telling me? The market is telling me that it's expecting inflation to be slightly above, longer term, slightly above the Fed's target of 2%, which is reasonable. inflation is being sticky, but it's not accelerating. So if we're going to have something like 220, 240, let's even call it 250, and the long bonds are going to go, or the 10-year is going to go towards the 5%, that means that we have a 2.5% real rate. And, here we are. If we go to 270 to 280, I would have thought we are done. I really can't see us going up through here, 275, and the stock market remaining sanguine about it. That's why I think that we have probably another 30 basis points to go, but that's about it. I would expect the 255 to be taken out just for fun, but then I think we're very, very close to a top. As term premia expand, of course, the yield curve should steepen. And here we have 3-month 10-year, which after breaking 00 is now at 31 basis points. So we've expanded about 30 basis points in the past week, and we are going basically to this kind of area. I would have thought another 20 basis points is what we can look for in that 3-month 10-year. If we look at then 2s, 10s, we can see that they're breaking down and they're going to around -40. But the real pain and the real move should start becoming now into the 5s, 30s, which are right up against the 200-day moving average, and that should retest at least -52 again, at least. And the real move should happen in the 10s, 30s, which are exactly where they were at the beginning of 2024, so we haven't moved anything at all in 10s, 30s. The likelihood is that we go back to these levels in 10s, 30s. So I would have thought the trades are 5s, 30s and 10s, 30s. I think that these levels are going to be seen again. And this is a move of another 10 to 17 basis points. So 5s, 30s, 10s, 30s are my favorite trade for the time being. Why 10s, 30s? Well, if we start issuing more at the longer end, the term premium expansion there should be felt in the 10s, 30s, and that is almost a pure term premium play. This will not last. It will break down. And don't forget that really, how far away from zero are we? We're very, very close. Let's expand that out. 10s, 30s never stay at zero. Never, ever, ever. And you'll remember that when last time they got to negative, we made a lot of money. We made like 18 basis points in a week. So this is very, very low risk. I think -29 to -35 in this spread is almost guaranteed at some stage in January or February. Let's have a look at the individual tenures. 2s. I think it's very, very unlikely that 2s can go above 242 or say 250. In this area, you really want to have them because of the positive funding, and it's very, very unlikely that data comes out so strong over the course of the next month or so that the 2s will start pricing in some kind of a rate hike by the Fed. I think that that is very low probability, and therefore anywhere in here you really do want to start building a long position in 2s. The pain really has to be felt at the longer end, whether we start from the 5s, which I think are unlikely to go much higher than the 460 area, but really it's going to be felt at the longer end. The 10s can make a run towards the, this 475, 484 area, and especially the 30s are vulnerable. they are vulnerable to spikes all the way up to 5%. And don't forget that as long as the stock market does not get the message that term premium is rising and the yield curve is steepening and that longer duration is getting sold and that real rates are going up, what does that mean? That means that people aren't switching, right? They're not switching from equities into bonds. And that means that bonds have more room to go because there are less buyers. So until we get some real switching between, let's call it TLT and SPY, i.e. out of SPY into TLT, whichever measure you look at, whether it's ITOT over government, and we'll look at all those later, that means that there is less demand for bonds while there is this constant issuing pressure, and therefore the bond market can go further. The only thing that's going to stop the bond market from going, to 5% or whatever these highs are around 515 is if the stock market suddenly has an air pocket. It's not happening, and therefore the probabilities of this actually going exponential are higher. So don't buy the long end. It's very probable that you get a real spike and then a V shape as the stock market then gives in. So the switching has to happen at these levels, right? It's not going to happen here because there isn't enough pain in the system. The pain will be up here, and that is where the switching is going to be. And that actually coincides with what I showed you, that term premium can go another 30 basis points without any problem, drag up real rates by another 20, 25, 30 basis points, and that is going to be the top, as it were, in rates, because the pain in the system becomes too much, and then people start switching and selling equities, basically saying that the economy can't take these levels. But there has to be switching, and switching is not happening now. Switching will happen at higher rates, and then you can have a V-shaped recovery in the bond market. It's pretty amazing how the US is dragging up Europe. This is the bobble, this is the 5-year, and my levels are absolutely perfect, 187, and that's it. Where are we going now? Well, we're probably going up to the 200-day moving average, and who knows, maybe even to 234. I really can't see it through there because that is another 14 basis points. Say the US goes another 30 and Europe goes 14, that's fairly reasonable. If we look at the 10s, where are we going? We're probably again against this 252 to 257 area, but that's probably going to be it in terms of the bonds. Europe is not the problem. The problem is the US, but the US is dragging everything up, and it's going up to these levels. And if you look at France, that is, to me, pretty screwed. And the spread of Germany to France is just so dangerous, just so dangerous. You are getting a crisis in France, and buying the French stock market, the bond market for the extra 70, 80 basis points of yield, to me is literally picking up pennies in front of a steamroller. This market could really, really, really do extremely badly over the course of, I don't know, the next 2 or 3 months. There is definitely a crisis going on there. And if these levels break, you're looking all the way down here. So a doubling of the spread. I really would leave France well alone for the time being. I'm sure that the ECB is looking at it. I'm sure that the ECB is supporting it. But I would much prefer to buy France once the crisis has occurred and we have this pricing around 140 to 150. that will be the time to buy France, not now. How dangerous things are becoming at the longer end of the bond markets is illustrated quite well by the 10-year gilt. 475, and we do 25 basis points in a couple of days. It's just very dangerous, and I think it's going to happen over the course of the next 2 or 3 weeks, that you have these spikes in the longer term rates driven by the term premium that expands another 30-40 basis points. I think it will do a V because the economy can't take it, but there again, until the stock markets really, puke 3, 4, 5% in a day, there won't be switching. And I think the only thing that's going to save the bond markets is switching. And therefore, I think this is very, very dangerous chart, exceedingly dangerous. It really can go 25, 30 basis points in a couple of days once it busts through this 475 area. Keep on looking at it. That could be one of the signals, because the gilt market is so much more volatile than the US, that things are really going to accelerate. In terms of spread between Europe and the US, as you can see, 2s are relatively stable. And that is because the short end of the yield curve is basically fixed in both. Yes, there is far more likelihood that the ECB cuts than the US cuts, so this will slowly go out. But the real pain is being felt at the longer end, where you are having really an acceleration of the spreads. It can only go so far, but where's it going to go? I would have thought that before everything is said and done in this spread, it really has to get to this about 250 area, 250 to 258. It's very unlikely that we can make it much past there. But that tells me that most of the pain, again, is going to be felt in the US and the UK, and probably least in the bunds. But still, the bunds are going to feel it. So if the US moves 30, this will move 15. And that slowly over time, sometime in January, I hope we get to 251 to 258. And that really should be all she wrote. And then the move can come back down towards this 202 area. But in the meantime, I'm still looking north. So in that case, let's have a look at TIP. What do I expect? I expect a further breakdown in an ABC kind of fashion. Could we go down and fill this gap down towards 103.25? Yes, but anything between 104.88 and 102.40 I think is accumulation area for TIP. Let's adjust it for dividends, and I think that it just becomes too attractive to own TIPs, because you can see how much money you are making with the dividend attached to it. If we manage to go down to this 103 area, you really have to be long of TIPs. It just makes sense. So this is the adjustment. Anything down here makes perfect sense to me to be long of TIPs. It's just too attractive. How long can it last? While what I've been describing is going on in the US bond market, it's extremely unlikely that DXY can do anything but test lower supports at around the 107.20 area down to 106.25. That is as low as it can dip. And really, what has it done since Fed Day? Nothing. It's remained in a range of where it busts through the daily Bollinger Band and basically consolidating. If we have a look at Euro USD, what's it done? It's basically consolidated there. It broke down, but every time it pokes its head up, there are sellers. can it go up towards this 104.60 area, and take all these stops here out? Absolutely. But after that, I expect it to start breaking down. I just can't see how Euro USD can remain bid while the differentials are still looking north. And while they're looking north, you still have to look north here. Let's try and enlarge this weekly chart. And if we enlarge it, we really see that the supports are really going to be here around the 102.60, and then finally, after a few weeks, at parity or just below parity. I am pretty convinced that this is all we can achieve for the time being, but I think that why would you buy Euro USD at the moment? It just makes very little sense to me until the differentials start calming down and say we've reached that 250 area in the bunds against the US. That should be the bottom in Euro USD, not before then. Gold is certainly much stronger than bonds, but I would have thought that if bonds do what I think they do, and that's that kind of up V, i.e. you spike higher in yield and then you come down, I think that gold can do the same thing. I think gold can probably come down to 25.47, stop everyone out here, probably spike the 200-day moving average, and then move higher. You can see how these averages are turning over, these shorter term averages between the 50-day and the 20-day. And that really is what it's showing on the weekly as well, because we haven't even reached the 0.382 of the big move, and that is likely to be around, so 0.382 is 25.02, and then the 50 is 24.02. I'd love to see this ABC break down and everyone get bearish of gold. That will be the signal to me that we can re-enter. I've been wrong in gold all year and I didn't see this break up, but I think we get a second bite of the cherry, and certainly 25.02 is where you want to start buying some longer term call spreads, because if I'm right and the real rates top out, that's going to support gold. Well, DBC had a dividend, didn't it? And therefore it spoiled my chart. So let's not have a look at DBC at all. Let's have a look at GSG, which did not have a dividend and is probably a better tracker for commodities. And this is the one I'll be tracking from now on, GSG. It really is doing nothing. We can, we've changed the levels. 2070 is the support and the really big one is 1977. But it's done absolutely nothing all year. This is the beginning of 2024. It's tried to go up. It came back down to where it started the year. And, that's it. Very quiet. And while that is going on, you have to ask yourself, why would five-year forward inflation expectations move very much? And therefore, why should real rates go much higher than, say, 270 to 75? It just doesn't make any sense. Term premium expanding and driving all those makes perfect sense to me. If you think there is a danger that they change the term funding, if you think there's a danger in the refinancing they need to do over the course of the next 2 or 3 years, 25, 27, 30 trillion dollars rather. So that makes sense, but term premium can only go up to a certain point, because once it's gone up enough, it really starts impinging on real rates, and real rates start impinging on the economy, and everyone switches into bonds because they reckon, no economy can take real rates above a certain level. Can you really see the economy doing well with 3% real rates? I can't. And I think in that case, commodity prices would get sold, and that would actually be an additional argument for why you want to own bonds, because you're now in a deflationary environment. So, no, I just can't see inflation accelerating. And while this is happening, until we start breaking some significant levels to the upside, I think that at some level, and I've tried to show you where bonds are a big buy. So here we have SPY TLT just in trend. But what is not moving is ITOT over government. So the totality of the stock market over the totality of the government bond market. And that is telling me that the only thing which is propping up the markets, the stock market, is really the big stocks, right? The magnificent 10, if you like. They are the ones, together as the largest components of the NASDAQ as well, are propping the market. That's all that's going on. If you look at what the Dow is doing, if you look at what the small caps are doing, they're all going down with the bonds, and that is keeping this in a range. SPY TLT goes much higher, and that will be your signal that you need to switch from equities into bonds. Let's have a look at SPX and my clean chart. I think now 58.65 is absolutely critical. I do think that we retest it over the course of the next few days, simply because of all the switching or rebalancing that needs to take place between stocks and bonds. I think that we test it. I think we might even break it and try and fill this gap. But then I think it's probably done for the time being. I don't think bonds are going to go absolutely berserk over the course of the next few days because of the rebalancing. There's going to be a lot of rebalancing out of stocks and into bonds, simply because of the relative performance over the course of the year. And therefore, that is unlikely to be the trigger for the stocks to start breaking down. If we get an ABC down here, I'm a buyer, because I think early next year stocks go up again. So to me, it's a period of stability in stocks until the bond market does what I described earlier and the long end really spikes up. Until then, I think all the dips below 58.65 are buys. Why do I think all dips are buys? Well, because of the NASDAQ. Have a look at this monthly candle in the NASDAQ, and let's assume it doesn't change very much in the next couple of days until year end and the next candle. It's just beautiful, right? So it's a beautiful green candle. It's still going up. There is absolutely no problem. Now let's have a look at the ES one. You can see it's a red candle. It's just impossible for the SPX to do much better while the bond market is doing what it's doing. Okay, so now let's have a look at what is propping up the market. And I just showed you, it's the NASDAQ, it's the big stocks. How is the SPX going to come below 58.65 and stay below there if that NASDAQ doesn't break down? Where does the NASDAQ break down? Well, the NASDAQ only starts breaking down below 20,400, and it's unlikely to do that. Look at where is the big support? It's right there. So an ABC in the NASDAQ, and you want to buy it. Yeah, 20,500, 20,400, you want to be a big buyer in the NASDAQ. And if we have a look at what that corresponds to here, what does it correspond to? This kind of level here. So if we start breaking down these lows, you actually want to be buying call spreads. You want to be buying call spreads anywhere in this area, 58.20 down to 57.62. You want to be buying call spreads right here. Neither the Nikkei nor the European markets are telling me that it's equities that are being sold. If we have a look at the monthly chart, we are actually very close to the highest monthly close that we've had this year in the Nikkei. And if we look at the stocks, well, we're not breaking down, are we? To me, both of these indicate relative stability and indicate the fact that there's less pressure from rates on those markets. And therefore, it just tells me that any big dip in the US is going to get bought as well. So you have my views. I think it's equities over bonds for the time being, simply because you still have this enormous support from the big stocks, the Magnificent 10 in the Nasdaq, and unless the Nasdaq starts breaking down, and I don't think it will, then it's unlikely that SPX can maintain very low levels, and I showed you where you should be buyer of calls. The final reason why I don't think that we're going to get much in terms of downside in the SPX is because the VIX isn't ready to break higher yet. I think it's going to take quite a few days of trading 14, 16 before we have another spike up to 20. So I don't think it's going to happen this year, and I don't think it's going to happen in the first few days of next year, but eventually we get that spike up to 20, and that will be when we have that switching between bonds and equities. It's not yet. So I think we are going to have a quiet end of the year and a quiet few days at the beginning until the next video next Sunday. So really any big dip in SPX, and it's worth buying. I've tried to show you how I'm thinking about the market. I've changed the levels of support. I think you want to leave the 30s well alone. I think you probably want to do some 5s 30s and 10s 30s to look for a steepening, to look for higher term premium, because I think they will spike at some stage, and that will be the opportunity to do switching from equities into bonds. But not before then. I think 58.65, if it gets broken for some reason, it's an excellent opportunity to actually buy call spreads as it goes down. I don't think that the stock market is ready to break yet. I think it's going to take quite some more time for that to happen. Thank you very much indeed, and tweet you tomorrow.